Audit Exertion. Review questions. Question number 1. What is the main objective of conducting an audit of financial statements? The main purpose of an audit is to provide financial statement users with an opinion issued by the auditor on whether the financial statements are presented fairly in all material respects in accordance with the applicable financial accounting framework. So, the main purpose of conducting an audit of financial statements is to provide the financial statement users with the auditor's opinion on whether the financial statements are presented fairly in accordance with applicable financial accounting framework. The auditor provides reasonable assurance, not absolute assurance, about whether the financial statements are free of material misstatements, which is caused by error or fraud. Question number 2. Distinguish between the term error and fraud. What is the auditor's responsibility for finding each? An error is an unintentional misstatement, whereas fraud is intentional. So the error is unintentional misstatement, whereas fraud is intentional. The auditor provides reasonable assurance about whether the financial statements are free of material misstatements, whether caused by error or fraud. So, the difference between the term error and fraud will be as follows. An error is an unintentional misstatement, whereas fraud is intentional. While, according to the auditor's responsibility, the auditor provides reasonable assurance about whether the financial statements are free of material misstatements, whether caused by error or fraud. Question number 3. What are the two classes of the audit assertion? There are two classes of audit assertions. The first one is transaction-related assertion, or assertions related to transactions. The transaction-related assertions must be met for any given class of transactions before the auditor can conclude that transactions are properly recorded. Number 2. Account balance related assertions, or assertions related to the account balance. The account balance related assertions must be met for each account balance before the auditor can conclude that the account is properly recorded. So, the first class, which is transaction-related assertion, must be met for any given class of transactions, while the account balance related assertion must be met for each account balance before the auditor can conclude that the account is properly recorded. First, we will talk about transaction-related assertion. There are 5 items that are related to the transactions-related assertion. The following 5 items are classified as assertions related to transactions, mostly in regard to the income statement. The first item is the existence. The existence means that the recorded transactions exist. The second item is completeness. Completeness means that the existing transactions are recorded. The third item is accuracy. Accuracy means that the recorded transactions are stated at the correct amount. Number 4, or the fourth item, classification. Classification means that the transactions included in the client's journals are properly classified. The last item is timing. Timing means that the transactions are recorded on the correct date. So, we have 5 items that are related to the assertions or classified as assertions related to the transactions. Number 1, existence, means the recorded transactions exist. Number 2, completeness, means existing transactions are recorded. Accuracy, recorded transactions are stated at the correct amount. Classification, transactions included in the client's journal are properly classified. The last one is timing, and this means that the transactions are recorded on the correct date. While, according to the second class of audit assertion, which is the account balance related assertion, the following 4 items are classified as assertions related to the ending balance in accounts, and so relate primarily to the balance sheet. Number 1, existence. Existence means here whether the assets and liability balances appearing in the balance sheet actually exist and should actually be included. So the existence here means that the asset and liability balance which is recorded in the balance sheet actually exists and should actually be included. Number 2, completeness. The completeness means whether all existing assets and liabilities are included in the balance sheet and nothing is missing. So the completeness means that all assets and liabilities are included in the balance sheet. Number 3, rights and obligations. Rights and obligations mean here whether the assets recorded in the balance sheet are owned by the entity and the liabilities included in the balance sheet are obligations that belong to the entity. So the rights and obligations means that the assets mentioned in the balance sheet are owned by the entity and the liabilities included are obligations that belong to the entity. The next question. Let the 5 transactions related audit assertions and define each audit assertion and give example on the assertion violation. The first item is existence. Existence means that the recorded transactions exist. This assertion deals with whether the recorded transactions have actually occurred during the accounting period. It deals with potential overstatements. So, the existence assertion deals with whether the recorded transactions have actually happened, have actually taken place during the accounting period. For example, inclusion of a sale in the sales journal when no sale occurred. This violates the existence objective. So the entity here included a sale in the sales journal and there is no sale happened or occurred, and this violates the existence objective. The second item is completeness. Completeness means that the existing transactions are recorded. The objective here deals with whether all transactions that should have been recorded in the journal have actually been recorded. So the completeness here deals with whether all transactions that should have been recorded in the journal have actually been recorded by the entity. It deals with potential understatement, which means unrecorded transactions. It deals with potential unrecorded transactions. For example, failure to include a sale in the sales journal and general ledger when a sale occurred, and this violates the completeness assertion. Here the example, which is related to the violation of the assertion, includes the failure to include a sale in the sales journal when the sale occurred, and this violates the completeness assertion. But on the other hand, in relation to the violation of the existence assertion, the example was inclusion of a sale in the sales journal when no sale occurred. The third item is accuracy. Accuracy means recorded transactions are stated at correct amounts. This assertion deals with the accuracy of information for accounting transactions. For example, there would be a violation of the accuracy assertion for sale of transactions if the quantity of goods shipped was different from the quantity billed, or the wrong selling price was used for billing, or adding errors occurred in billing, or the wrong amount was included in the sales journal. So, if any of those have taken place, will lead to a violation of the accuracy assertion. Number 4, classification. Classification means that the transactions included in the client's journal are properly classified. and this assertion deals with whether transactions are recorded in the appropriate account. So the classification assertion deals with whether the transactions are recorded in the appropriate account. Examples for misclassification for sales are including cash sales as credit sales, recording a sale of operating fixed assets as revenue. These two cases are examples for misclassifications for sales. Number 5, timing. Timing means that the transactions are recorded on the correct dates and proper periods. For example, there would be a violation of the timing assertion F. Sales transactions is not recorded on the date of shipment to the customers, or the transactions that occur near the end of the accounting period are recorded in the subsequent accounting period. So, there are two examples related to the violation of the timing assertion. The first one, if the sales transaction is not recorded on the date of shipment to the customers. The second one is related to transactions that occur near the end of the accounting period are recorded in the subsequent accounting period. Question 5. List the 4 account balance related audit assertions and define each audit assertion and give examples on the assertion violation. Number 1. Existence. Existence means here whether the assets and liability balances occurring in the balance sheet actually exist and should actually be included. So the existence here means whether the assets and liability balances appearing in the balance sheet actually exist and should actually be included. For example, related to the violation, including accounts receivable from a customer in the accounts receivable trial balance when there is no receivable from the customer, and this violates the existence objective. So, when including accounts receivable from the customer in the accounts receivable trial balance when there is no receivable from the customer, this means that there is a violation to the existence objective. The second item is completeness. Completeness means whether all existing assets and liabilities are included in the balance sheet and nothing is missing. For example, failure to include an account receivable from a customer in the account receivable trial balance when a receivable exists, and this violates the completeness objective. So, when the entity failed to include an account receivable which is received from the customer in the trial balance, this violates the completeness objective. Number 3. Rights and obligations. Rights and obligations assertion means whether the assets recorded in the balance sheet are owned by the entity, and whether the liabilities included in the balance sheet are obligations that belong to the entity. So the right here refers to the assets recorded in the balance sheet, and the obligation indicates the liabilities included in the balance sheet. Example on violation of rights and obligation assertion. Physical inventory count shows that the entity doesn't own all the inventory recognized in the financial statements. So this means that the entity recognized inventory that is not found in the physical inventory counts. Number 4, valuation assertion means whether asset, liability, and equity amounts are included as the appropriate amounts. So valuation means assets, liability, equity amount included at the appropriate amount. Example on violation of valuation assertion. Uncollectible receivables haven't been allowed for properly. Allowance for bad debts have been understated when recording the accounts receivable.